AI bubble, private credit, the Iran war. Is the US stock market resilient or in denial? How much is the Trump put really worth? And what should you be doing with your money right now? Once riding a tiger, it is difficult to get off. This ancient Chinese idiom was brought into modern political discourse by no other than Mao Zedong. Mao famously used it to describe US involvement in the Korean War. His point was that after the United States had committed to the conflict, it could not easily withdraw without losing credibility. The surprising resilience of the US stock market since the start of the Iran war reflects a widely held view on Wall Street that Donald Trump will quickly topple if the oil market becomes unhinged. Trump's declaration last week that the war will be over soon, after oil prices spiked to nearly $120 a barrel, only reinforced the market's conviction that Trump will blink before the oil market breaks. But will Trump blink? Put differently, can he get off the tiger easily? The reality of the Iran war, that neither Washington nor Beijing will openly acknowledge, is that it may be the first true proxy conflict in the US-China great power rivalry. That the first such conflict will break out in Iran rather than Taiwan was far from obvious. Indeed, until recently, Beijing was reluctant to provide Tehran with any meaningful strategic backstop. But Trump's unilateral actions against Venezuela may have forced China to reassess the risk of remaining on the sidelines. Iran is a critical hub in China's Belt and Road Initiative, a land bridge linking Central Asia to the Middle East and Africa, designed to reduce China's dependence on maritime routes vulnerable to US naval blockade in a future conflict. Therefore, a US-engineered regime change in Iran would put China's investments and much of its regional strategy at risk. Indeed, as I argued in a previous video, Beijing may have interpreted, rightly or wrongly, US hostility towards Iran as indirectly aimed at China. Given this, it should not come as a surprise that China has deepened its involvement with Iran since the 12-day war last June. Earlier this week, Iran's foreign minister claimed that Iran was receiving assistance from China and Russia, including military cooperation. This stands in sharp contrast to Tehran's open criticism of both countries for doing little to help during the 12-day war. Signs of military cooperation between China and Iran have been growing for months. Multiple reports point to shipment from China of sodium perchlorate, a key precursor used to manufacture solid rocket fuel for ballistic missiles. Iran probably would not have been able to rebuild its missile arsenal after the 12-day war as quickly as it did without help from China. More recently, there were reports of deployment of advanced Chinese YLC-8B radars that are said to be capable of detecting stealth aircrafts like the B-2 bombers and the F-35 fighters. 2 weeks ago, Reuters reported that Iran was close to completing a deal to purchase Chinese CM-302 supersonic anti-ship missiles, capable of threatening US naval forces, including aircraft carriers in the Persian Gulf. Iran has indicated that it's also been receiving intelligence support from China and Russia. During this conflict, Tehran appears to have shifted away from reliance on civilian GPS towards China's BeiDou satellite navigation system, which may help explain why its missiles and drones appear more accurate and harder to jam than during last year's 12-day war. It is reasonable to infer that this shift is contributing to Iran's greater success against US military targets than many had expected. Open source intelligence suggests that Iran has destroyed or damaged multiple US and allied air defense radars across the region, including at least one THAAD radar. The Wall Street Journal has reported that several US refueling aircraft were damaged in an attack on a Saudi airport last week. Meanwhile, the reposition of 2 US carrier strike groups away from Iran, amid reports of attacks and operational incidents, suggests that the operating environment has become much more contested than anticipated. What China appears to be providing is not battlefield control, but the space-based infrastructure that is making Iran a far more effective fighting force. I argued last week that tackle is not an option for Trump in this war. I argued that for him to tackle, he will have to be ahead in the war. Given he's no longer ahead, he's forced to keep going until he's ahead again. Another reason why Trump cannot tackle is China's involvement in the war, which has raised the stakes considerably. For Trump to walk away now would be tantamount to accepting defeat in the first proxy conflict between the United States and China. Beyond the immediate hit to U.S. prestige, such an outcome will almost certainly undermine future demand for U.S. defense exports, something the powerful American military-industrial complex would never allow. Moreover, if the regime in Tehran survives the war, it will almost certainly accelerate the consolidation of ties between Iran and China, making it far harder for the United States to contain Iran in the future, not to mention China's expanding footprint in the Middle East. As I mentioned in a previous video, a new rail corridor linking China to Iran is nearly fully operational. Stretching more than 10,000 kilometers across Central Asia, the line cuts transit time between the two countries from roughly 30 to 40 days by sea to about 15 days by land. More importantly, it will provide Tehran and Beijing with an overland trade route that is far less vulnerable to U.S. sanctions. There is a strong case to be made that this may be the last window of opportunity for the United States to prevent Iran from becoming firmly anchored in China's strategic orbit. But it won't stop there. If the mullah regime in Tehran survives this war, the consolidation of the China-Iran axis could reshape the geopolitical balance of the entire Middle East for decades to come. If Trump were to walk away now, the Gulf states will be left to confront a more emboldened Iran on their own. This will certainly open the door for China, already the largest importer of oil from the region, to replace the United States as the security guarantor and power broker in the Middle East. I don't believe anyone in Washington can live with that. In my view, not only tackle is not an option, regime change may be Trump's only option right now. My gut says that Trump understands that he has little choice but to finish what he started. If he has not articulated this publicly, it may be because doing so would risk pushing oil prices higher and equity markets lower. But the market will eventually come around to the same conclusion. There is simply no easy way to reopen the Strait of Hormuz. In my baseline scenario, the United States may have to consider seizing control of parts of the Iranian shoreline around Bandar Abbas through an amphibious operation. This is the only way to break Iran's stranglehold on tanker traffic. The U.S. stock market would likely react poorly to such an outcome, particularly if it's accompanied by rising American casualties. It would not take too long for investors, even the retail buy-on-dip crowd, to quickly realize that rising casualties make U.S. disengagement even less likely. But Trump might decide to take his time. But the longer he waits to deploy troops on the ground, the longer high oil price will be here to stay. With the disruption of more than 10 million barrels per day, oil price will likely to be heading even higher. Stanford Institute for Economic Policy Research estimates this week that surging oil price could completely offset the financial benefits of recent tax refunds. And this only assumes a 3-week closure of the Strait of Hormuz. Of course, in an extreme scenario, Trump could move to restrict U.S. oil exports. This would ease pressure on consumers in the short term, but it will come at the expense of U.S. oil majors, whose share prices will likely take a huge hit. Bond yields have been rising in tandem with surging oil price. However, if the U.S. stock market falls more than 10 to 15%, and the market starts to worry about a sharp economic slowdown, the Fed will start to sound concerned, which in turn should provide some relief for bonds. Don't get me wrong. I'm not saying that bonds are cheap, but I just think that stocks are extremely expensive thanks to the retail buy on dip investors. Bonds don't need to be cheap. They just need equity bulls to give up. The same is probably true about gold, that recently has been trading like bonds. As for the US dollar, I suspect it will peak only when bonds have troughed. Thank you for listening.